similar to where silver peaked at $50 in 1980. You could get this blow off top where it reaches 300. It's the kind of peak that we could potentially see. And so how I get there is through multiple indicators. One of the main ones is the gold silver ratio. And that's very simply the price of gold divided by the price of silver, which tells you how many silver ounces it takes to buy an ounce of gold. And that ratio varies over time. Right now, we're close to, I believe it's 85 or 90 ounces of silver. And that has averaged about 55 to 60 ounces of silver to buy one gold ounce over the last, say, 20 or 30 years. But in the 1970s, when we have a good analog, which was the last bull market for silver and gold. And by the way, silver returned about 3,700% in that bull market, and gold returned about 1,400% in the 1970s. So silver more than 2-for-1 outperformed gold. Silver went from about $1.30 to $50 from 1971 to 1980. In 1980, when silver peaked at $50, the ratio dropped to an ultimate low of 15. It took just 15 ounces of silver to buy 1 ounce of gold. And that ratio at that point was very much out of whack. It was very far from its mean, from its average, and was in all likeliness due to bounce back and go higher. And so it did. Silver prices fell, gold prices also fell, but silver prices fell more rapidly percentage-wise, and things went back to normal. So if we use that as a comparison for today, I look at forecasts, what I think are reasonable forecasts for the gold price in the ratio. So we have people like Jim Rickards, people like Shane McGuire, who ran a gold fund for the Texas teachers retirement system. We have people like Scott Minard, who is I believe, a chief investment officer for Oppenheimer, and I believe he's some sort of advisor to, I believe it's the New York Fed. So these are people that are highly regarded. In some cases, we have a forecast by these respected analysts of anywhere from $5,000 to $10,000 gold, ultimately. And I've been saying publicly since back 2009, 2010, that I think gold will easily reach 5,000. We were not long ago at 2,000. And so, from a level of 2,000, $5,000 is 2.5 times. I feel that's not unreasonable. I feel that we are still in a very long secular bull market for precious metals. And so let's say gold goes to 5,000 and we reach a similar low in the ratio of 15. So if you divide 5,000 by 15, that's $333 silver. I round down to 300, and that's one way I got to 300. History rhymes, but doesn't necessarily repeat. And I look at the US debt to GDP ratio, and I go back to 1970. And in the 70s, the debt to GDP in the US was actually trailing downwards, which is really hard to believe that in that period, debt actually went down relative to GDP. And it ended the 70s, so around 1980, at around 30% US debt to GDP. Today, we're at about 130%. So for me, what that means is that we are in a similar period, meaning inflation is going to run. Interestingly, how inflation behaved in the 70s, and it wasn't a constant straight line up. It was actually a series of waves. So we had 3 waves of higher inflation. And the reason for that was because the Fed would try and step in, raise rates like they're doing now. Inflation would back off. It would not drop to the previous low. It would drop to maybe half of that bottom to top run, and then it would start to rise again. That's because the Fed and other central banks start to back off when they see recession. So that might be as little as 6 to 9 months away when the Fed will start to say, oh my goodness, there's recession. People are panicking. We need to perhaps not just stop raising rates, start backing off. Their hands really are tied. If we go back to what I was saying in the 70s, we had these 3 waves of inflation. Inflation ran up, corrected. As I say, the Fed stepped in, raised rates, backed off. Inflation kicked back in again. Fed stepped in again, raised rates, then again eventually backed off with recession. And then you had this third wave when inflation just went absolutely crazy, up to 14%. And things were calculated differently. So they actually were much more realistic inflation rates back then. But ultimately, the Fed under Volcker in the US was able to raise rates up to 20%, which absolutely sounds astronomical right now, because the debt to GDP level was so much lower. In other words, not just government. So government debt was a quarter of what it is right now versus the size of the economy. But homeowner debt, mortgages were much less burdensome. Student debt, car loans, consumer loans, all of these things were much, much less inflated than they are today. People could handle, and governments and business could handle much higher rates, even if it was just for a short period of time to break the back of inflation. Today, I believe that's completely impossible. There's absolutely no way that central banks can raise rates sufficiently to break inflation's back. And I think so what will happen is that they will raise rates as much as they can, knowing full well that inflation is running much higher than where they're able to go. And frankly, they will let inflation run, because it becomes a choice between raising rates enough, which they realistically can't do because debt levels are so high. And even if they, let's say they did, and they were to break the back of inflation, they would absolutely crush the economy. And so they know that. We actually do not know who owns the Fed. It's a spread ownership across the main banks, the larger US banks. And so there are apparently no clear guidelines on exactly who owns the Fed in what capacity, et cetera. And so it's absolutely ridiculous to think that such an institution that decides on the price of money and has so much power has to be so veiled. It's just incredible that this is how the strings are being pulled on our economy. It's amazing that we've gotten to this point. It really is. My money is on history, 2, 3, 4, 5,000 years of history. Silver is the most used asset as money throughout history. More transactions over time have taken place through silver. And an interesting thing about silver is that it is both, compared to any other metal, it is both money and an industrial metal. Half of silver is used for industrial purposes. The other half of silver is some sort of investment or decoration or jewelry, which you could argue in many ways is a form of savings and therefore a form of investment. In a broad way split, it half between investment and industry.